For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Well, hello there. Hi. Johnny Dean, podcast host, Managing Your Financial Future. Welcome back. After all the excitement last week, Professor Plum. Hello, Professor Rick Plum, who is a certified financial planner professional and an accredited wealth management advisor, AWMA. Did I cover everything at the top of the hour?
You got that out of the way right off the top instead of remembering it just before we sign off.
Well, I was so excited last week because, episode 200 and the whole thing. And of course, all the fanfare that we had and the bands were playing and the confetti was flying. And none of that happened, as you know. But it was still a really good show. And now I said I got to top this one. We're episode 201. I got to stop counting at this point. Nobody cares what episode number this is. Quite frankly, if I may be direct with people, because that's exactly what they're saying. But anyway, so this week I'm getting your credentials out of the way right away, and I thank you for joining me. I know you had a little appointment that ran a little long.
I've had a couple of appointments that ran a little long, which backed up everything else. I feel like a doctor's office at times. It's like, oh no, this one's taking long, so that's going to back up the next one. Just going to back up the next one.
Well, that's the thing. And, maybe we should do these early in the morning. Get these out of the way early in the morning. That way, first appointment is never late. Anyway, speaking of late, well, it's not late, but it is late in the year. Did you notice that? We've only got a couple of weeks left in this year.
I know, and luckily I'm done shopping. Are you?
No. Why is it the 24th? No, it's not the 24th. No, I am done. There are a few other things. I got some folks coming in town here let's see, I think on the 23rd. So I got some relatives coming in town. That's going to be fun. That's going to be an awful lot of fun. So, but it is late in the year, and it seemed to me that we should talk a little bit about some of these new. Now, we're not going to spend the whole time, so don't go running and screaming and turning off your podcast or whatever, folks. Not going to be doing this the whole time, but I think there's some important limits that have changed, some new things that have happened with 401ks and catch-up contributions, and limits that you need to understand for next year. Because now remember, Professor Plum, we have this Tax Cut and Jobs Act thing that expires at the end of 2025. So some things could be happening next year.
Well, we're going to have a lot of information, a lot of debate, a lot of name-calling probably in Congress over the next year to see what, if any, which provisions, if any, of the provisions of the Tax Cut and Jobs Act will be extended, if any, or whether they're going to let them all just expire. And so we know that there's the potential that something gets extended because of the way the election went. So, we'll see what happens. But the way it sits right now, there's really not a lot happening for 2025 as compared to 2024 when it comes to the tax brackets. Yes, the tax brackets, as always, have increased slightly. Not the bracket themselves. We have the same 10%, 12, 22, 24, and on up the line. We have the same brackets, but the amount of money that we can have in each of those brackets has expanded a little bit. I mean, for a married couple that files a joint return with a taxable income side, they used to hit the top of the 12% bracket at $94,100. Now it's $96,950, almost $97,000.
All right,
so we have a little bit more room in the 12% bracket, a little bit more room in the 10% bracket, a little bit more room in each of the brackets, and a little bit larger standard deduction than we had for the 2024 tax return.
All right, so let's start with this. Now, you just mentioned the tax brackets. You've got, in that 12%, you said there's, about another $3,000, a little less than $3,000 of room there in that 12%?
$2,850.
$2,850, so call it $3,000. So that's an extra $3,000 that was
$650, I'm sorry.
Okay, well, we'll say $3,000 or so, a little less, that would have been taxed at the, what's the next bracket up after 12? 22. So you save yourself a little bit there every single year when these brackets expand. Now, the one that's gotten the largest, I think, is probably, the 10% bracket. What is that now?
the 10% bracket, the first 23,008. This is for a married couple filing a joint return.
Yeah.
It was 23,200. Now it's 23,850. It went up $650. So we have just a little bit more there. We have, for a married couple, the standard deduction went up by $800. It's now $30,000 for a standard. Now, if you itemize, that doesn't mean anything to you because you take your itemized deductions instead.
Yeah.
But so if your income is exactly the same this year or in 2025 as it is for this year, and your deductions, you either use the standard or you have the exact same deductions in 2025 as you had in 2024, your taxes will go down a little bit.
Yeah. Just because of the
2.5%
bracket creep. Is that bracket creep? Is that what they're calling that? Or is that?
I think that's,
I usually think of that in the negative sense, but it's the expansion of the tax brackets.
The expansion of the amount of money you can have in each of the brackets.
Yeah.
The bracket themselves, as I mentioned, does not change. Still 8, 12, 22, 24, 32, 35, 37. Now, 37 does not happen for a married couple unless they're making, with a taxable income after deduction, more than $750,000.
Yeah.
But hey, I wish to be in that tax bracket.
Well, we can all hope to be in that tax bracket, just like we all hope to be paying estate taxes at some point. Well, I don't want to pay them. I want to be subject. I want to be subject to them. I don't really want to. Yeah, I don't want to pay them because heck, that means I'm not.
I would rather pay them than my kids pay them because that means I'm the one inheriting something.
Yeah. Okay. There you go. There you go. No, it's not going to happen. Not going to happen for either one of us. All right. So the new tax brackets, they did go up, and that's kind of good. That's for the ordinary income tax brackets. Now we've got capital gains tax brackets as well?
The capital gain brackets are the same. The amount of money that we can have in the 0%, the 15% has expanded by about 2.5%. So a little bit more it's similar to the 12% bracket. It's just actually slightly under the top of the 12% bracket, where the 0% long-term capital gain qualified dividend bracket goes to 15%. The one that does not change is the net investment income tax for people that are single that make more than $200,000 of adjusted gross income. They are hit with another 3.8% tax on any investment income they show on their tax return. That $200,000 number hasn't changed. For married couples, it's $250,000. That hasn't changed. So if you got a little raise, maybe you hit it a little sooner. But so some things changed, a little bit more room. Some things didn't.
Yeah. All right. So just be aware of these different levels, capital gains. I mean, it's always better, even just a little bit, to have these brackets expanded. I mean, they go up with supposedly inflation. And so inflation was roughly 2.5%. The amount of room in each of the brackets went up roughly 2.5% pretty much across the board. Yeah. All right.
Your standard deduction went up by a little bit, about with inflation. The one thing that went up more than inflation was the wage base, the Social Security, the FICA wage base. For people who make more than certain numbers, this year it was $168,600. Next year it'll be $176,100. We pay FICA tax. FICA is the Social Security portion of it, not the Medicare portion of our Social Security benefit, and we pay tax on the first 6.2% as an employee. The employer also pays 6.2% of our income up to a certain level. Once we hit a certain level of income, then we stop paying into the Social Security system. Now, it also doesn't count towards our benefits anymore either. But so people that make more than last year, or this year, I should say, $168,600, they saw a little bit of a raise in their paycheck because less was being withheld. Next year, it's going to take longer to get to that raise because the wage base went up by 4.5%. Where they came up with 4.5%, that's their doing. But yeah, so we now get to pay Social Security tax on a higher number. So isn't that fun? Well, for those of you who are making enough money to worry about that.
Yeah, which is good. Now, as we say, you get a little bit of it. You get a 6.5%, 6.2% raise. Some point in the year, that raise now comes maybe a couple of weeks later, depending on how much money you're actually making. So, but that's just what happens. So that's one of the things that got expanded that isn't necessarily a good thing for people. You are going to be paying a little bit more. But on the other hand, I suppose you have, your benefit will go up based on, the wage base doesn't necessarily, Professor Plum, increase out of step with the amount of money that they give you as a Social Security increase. Is that correct generally?
Well, when they calculate a Social Security benefit, they look at your income, and then they average. They inflation adjust prior years, and then they average out your best 35 years. But if you are over the wage base, they don't include all of your income. If you're making $400,000 or $500,000 a year, they don't include $400,000 or $500,000 a year
up to the
come
wage
up
base.
with your average income. They only use your actual income up to the wage base. If you're over the wage base, they don't count anything over that. So when they're calculating your benefit, once you stop paying Social Security taxes on your wages, they stop using that income for calculating your benefit too. It's just life in the big city. So
yeah, no, and that's fine. That's probably the way it should be. I mean, this is not a tax to fund Social Security. It is a tax to be a member of the Social Security Club, so that politicians can't take it away. I love bringing that up because that's exactly what FDR said. All right, so we've also got new, just very quickly, because I don't want to spend like a ton of time on this. We've got new estate tax exemptions, I believe, gift tax, and all that too.
Right, for the moment.
Yes.
It was 13,006. I think it's now 13 million.
13 million. Yeah, 13,000 would be
almost
tough.
14 million.
14 million. Yeah. Okay. And
$13,990,000.
And that's per person once again.
Per person.
And it's with the portability. I mean, somebody generally a spouse will outlive another spouse. So if for some reason you're worth close to $28 million or just under, I mean, if you lose a spouse, you're not going to lose that exemption.
Now, you do have to actually do something to take it over. But now, one thing that did go up, and this is a confusing area, the annual gift tax free gifts went from $18,000 in 2024 to $19,000 in 2025.
Wow, is it really that? Yeah, you know what? We talk about that so very rarely, and we used to talk about it on our show when we did our daily show. But I mean, I was still thinking it was around 15,000, and now we're up to 19,000.
Right, and the reality, though, is for most people with a almost $14 million lifetime exemption, the annual number really doesn't matter too much, because how many people in their lifetime, during their lifetime or a death, are going to be worth more than $14 million being passed on through to other people, to other non-spouse individuals.
Yeah.
And so that's the confusing part. People think that they can't give more than $18,000 this year, $19,000 this year without paying a tax. And that's not a true statement. Once they pass $18,000 of a gift this year to any one individuals, technically they are making a taxable gift, but there is a gift tax credit for the tax on the first $13 million for next year, $13,990,000 that we give away. So most people just are not going to have to worry about it.
Yeah, it's a lot of money. You could die with a lot of money and still pass it on to heirs. And of course, these laws were designed by people who have a lot of money that they didn't want to give up. And so this is why you have
so cynical, John.
14 million per person that keeps going up. I mean, it was not that long ago. Here, I'll say this, my once a year rant. It was not that long ago, and I'll say 25 or so years. It was right around $1 million that you could give away. And then after that, you had to pay estate taxes. Well, they sure fixed that. $14 million, and of course the $3,000 ordinary income tax deduction, not a deduction, but the exclusion, I guess. That hasn't changed, Professor Plum.
The exclusion. I'm sorry.
No, the $3,000 of ordinary income that you can deduct.
But you're talking about capital gains?
Yeah, I'm talking about when you take a loss. Yes.
Capital losses have been the same since, I think, 1972. $3,000.
Yeah, $3,000. Big deal. Thanks a lot.
The threshold for taxability of Social Security has been the same since it was enacted in 1983, and then a second threshold in 1993. Those have not changed.
Those have not changed. No, they're never going to do that. So, hey, you know what? But that's because, rich people don't need that. All right, so I got to stop talking about that. It always bothers me. Let's see. Just a couple of quick things here before we move on to something else. This I really like, Professor Plum, and I don't know why. Maybe because I get to take advantage of it. But the 401k catch-up, there's an added catch-up age. Now, talk for a moment about the catch-up, and I don't mean like catsup, the catch-up provision, which starts age 50 and older for 401ks and IRAs.
Well, for the past couple decades, we've had a fairly straightforward system where we had a deferral limit. Everybody could defer X amount of dollars per year from their paycheck to their 401k, their 403b, their retirement plan, whatever kind they were using. And then for age 50, if you turned 50 during the year or later or older, you got an extra amount that you could put in because you're playing catch up. We have it for IRAs, we have it for 401ks, and for 2024, for people age 50 and older, we were able to do our typical $23,000 of salary deferral that everybody can do, but then also do an additional $7,500 of contributions to our salary deferral plans, 403b, 457, 401k. So for a total of $30,500. Now, for 2025, the normal limit for everybody, the $23,000 limit, is going up by $500. So that limit goes to $23,500. For the age 50 and older, that $7,500 number is not going to change. That number stays the same for 2025. However, we have a brand new category that we've never had before, and it's for a 4-year age period. If you reach age 60, 61, 62, or 63 by the end of 2025, your catch-up provision isn't $7,500. It's 150% of the $7,500 or $11,250. So if you're within that 4-year age bracket, you get a bigger catch-up provision. But if you turn 64 by the end of 25 or older, you're limited to the $7,500. If you don't turn 60 by the end of the year, you're at the $7,500 mark. So we've got this funky. At age 50, it goes to $7,500. At age 60, it goes to $11,250. At age 64, it comes back down to $7,500. What the heck is that all about? And that starts for 2025.
Try to make sense of it. But I'm happy to say, number one, it's kind of a creative thing to do. I do kind of like that. I think it's good, number one.
Well, you like it because you fall into the age gap that you can do it.
And that was going to be number two, was that I fall into the age category because this is
I don't like it because I don't fall into it anymore.
You just missed it by like a year, Professor Plum. And again, it's the year you turn that age. So if you turn,
well, it's the age you reach during that year,
right? So if you turn age 60 in January, it doesn't matter. I think some people might think, well, I don't turn age 60 till December 1st or something. So I don't get to put the extra amount in till after I actually hit 60. No, it's that year. So right. You could have next year. You can do it all year if you turn 60 in that year.
Right. So if you want to, spread that 11,250 out across the entire year over and above the 23,500 you're doing.
Exactly.
You can start. Yeah. If your birthday is December 28th, you can start January putting that extra 250 in.
Sure. Yeah. And it's nice to have. All right. So you know what? There's others here. I'm starting to get tired of just giving out numbers because I don't know how interesting this is.
Boring.
It is important, though. It is important. And I think that catch-up thing is something that people need to know about, especially for people who are trying to plan for taxes next year. If they're making more money next year or something, you can defer a little bit more. I do like that. Even if it didn't affect me, I still kind of like that. I know we have a couple of things like safe harbors. If you want to withhold more, we can talk about some of that stuff. But one of the things that I'd like to get into, are there any more important limits we need to know about?
Not really. I mean, the IRA contribution limits are the same. They didn't go up.
Which are what again?
7,000 and 8,000. Age 50 and over is 8. Under 50, it's 7.
All right. So for traditional IRAs or Roth IRAs, you've got $7,000 limit. If you're age 50 or older, you can do 8,000.
Right. The amount of income you can have and still contribute directly to a Roth IRA has gone up a little bit. So that helps out, nicely.
Just what is that briefly?
236 to 246. So if your income as a married couple filing a joint return is under $236,000, you can make a full Roth contributions directly to the Roth. It's phased out over that $10,000 room from 236 to 246.
Yeah.
Once you get to 246, adjusted gross income, then you cannot contribute directly to a Roth IRA. You have to look more towards the backdoor Roth if you're eligible for that or something of that nature.
Yeah.
Single individual is now 150 to 165 is your phase out.
Funny phase out.
It's just numbers.
Yeah, it's just numbers. All right. Okay, that's all I want to spend on that, honestly. That's probably more time than I wanted to spend on that. But it is important, as I said. Now, let's see. Now, we're approaching the end of the year. I don't like to necessarily do things where you say, hey, you got about 3 weeks left in the end of the year, and, here are some tax things that you could do. Because honestly, Professor Plum, there's not a lot from a tax standpoint that you can fix at this point, I don't think. You can't really adjust your withholding. I mean, you could. It's probably not going to make much of a difference now.
Well, you just don't have that many paychecks left in the year.
Right,
that you can make a significant difference with.
Yeah,
I mean, if you look and you say, well, I want to max out my IRA, or my 401k, I've only put in $4,000.
Well,
and you want to max it out at the 30,500 because you're 50 and older. Are you going to get enough paycheck that even if you deferred 100% of it, you could get it up that high?
Could you do if you get a bonus into the end of the year? I suppose you could, right? Could you ask if
they pay the bonus before December 31st?
Right. Yeah, that's possible.
A lot of times, year-end bonuses are paid based on the year-end numbers, and it's paid in January.
So that may not happen.
That doesn't count for this year.
No, it doesn't. But if you're 60, 61, 62, or 63 next year, you may be able to do that. All right. But one thing I'd like to mention here, Professor, is the Qualified Charitable Distribution. Qualified Charitable, QCD.
Distribution, donation, whatever you want to call it.
Yeah, I just...
Whatever it takes.
Okay, the QCD. And this is something that you can do here. It's something you can be doing all year. But if you would please, Professor Plum, talk for a moment about this QCD and how it can help you and why you may want to do this at the end of the year, especially if you're still looking to do RMDs.
Well, we run into a little thing. If you're looking to save on taxes, doing a charitable donation isn't, especially if you're doing it with cash or something, is not the best thing in the world, unless you really wanted to give the money to charity in the first place, and then the charitable donation just helps, or the charitable deduction helps. But a QCD, a Qualified Charitable Distribution, is where if you're 70 and a half to the day or older, it's not the year you turn 70 and a half, it's the day, you can have money transferred directly from your IRA. So if you're just now looking at it and saying, you know what, I forgot to do my required minimum distribution. I'm 73 years old this year, or 74, 75 or older, and I've got a required minimum distribution. I really don't want to take an RMD, but I do want to give some money to charity. You can have the money sent directly from your IRA to the qualified charity. It does not come to you. It goes from your IRA directly to charity. And if accounted for correctly on your tax return, it doesn't show up on the tax return. And that's a nice thing, because a lot of times and some people say, well, I get to take a deduction for it anyway. Well, that may be true, but a lot of seniors, and obviously this is only for seniors because you can't do it unless you're 70 and a half or older, don't itemize their deductions. And if you don't itemize your deductions, you're not getting a charitable donation. But even if you are itemizing your donations, there's no harm in doing a QCD and accounting for it correctly, because it reduces your adjusted gross income. And if you reduce your adjusted gross income, because let's say that I move $10,000 from my IRA to the charity as a QCD, if I take that $10,000 as a distribution and then give the money to the charity, the $10,000 shows up as taxable income. It shows up as part of my adjusted gross income. That adjusted gross income dictates how much of my Social Security is subject to taxes. It tells me how much I can deduct as a medical expense. It tells me whether or not I can do multiple other things, because my adjusted gross income is the gatekeeper for a lot of other things down the line on the tax return. The lower my adjusted gross income is, the less I may have to pay in taxes, the more I may be able to deduct, and some other things happen. So even if I can deduct the $10,000, it may be helping me elsewhere to not show it as taxable and not show it as a deduction. So it's just, I can't find a negative portion. This is one of the few areas that I can't find a negative in
Even
now,
if you
your
look.
Social Security is already taxable,
Yep.
if you're not throwing your adjusted gross income up into the IRMA level, if you're not throwing your adjusted gross income up into the net investment income tax level, if nothing else negative is happening, and you take the $10,000 as income and then you deduct it on the other side, you're no worse off doing a traditional distribution contribution than you are with a QCD. But why muddy the waters? I like the charitable donation, the qualified charitable donation.
Yeah, you and I both do. It's been around for a long time. It was only recently that they kind of made it a permanent part of the tax code, I guess. It was always sort of up in the air, or it had to be renewed every year, or whatever the situation was. But some people just, the point is that some people think, well, wait a minute now. I have a $10,000, or let's say I have a $5,000 required minimum distribution. I'm going to keep it in line with that. $5,000 required minimum distribution. I'd like to give $5,000 to the church or whatever charity I have, qualified charity. So what's the difference? I take the $5,000 out of my IRA as a required minimum distribution, and then I turn around and I write a check of $5,000 to the charity. Well, I had $5,000 coming in as income, but then, of course, let's say I could deduct it, and so I say, well, I've got a $5,000 check going out. And so it's a wash. So I don't understand what the deal is. But as you said, Professor Plum, the very fact that you took that as income for that year, it does make a mark, a little footprint, sometimes a big Monty Python footprint on top of your tax return. Not so much for the income, but for the other things that you mentioned earlier. And the good thing about this qualified charitable distribution, this QCD, is, as you said, it doesn't make a mark on your tax return. The money goes directly from your IRA over to the charity. I like that.
Yeah, and we've actually had the QCD for 18 years.
Yeah, it's been a long time. 18 years.
In 2006.
2006. I wonder why. I mean, it's a good idea. I was thinking the last good thing they really gave us was the Roth IRA. But
that was 98.
That was 98, and that's been a long time. So, 25, 6, 7, something like that years. That's been a long time. But honestly, this QCD idea is good, and nobody really talks about it.
Well, and it's interesting because there's a lot of misconception. It is designed to cover the required minimum distribution or apply towards the required minimum distribution. But it doesn't have to be the RMD. Let's say that I've got that proverbial $1 million IRA and I took $40,000 out of it already this year, which is enough to satisfy my required minimum distribution. I had to live. I had to take some money out of my portfolio to live, so I took $40,000 out to live. But now I decide that I want to make a charitable donation. Well, I've already satisfied my RMD for the year. That doesn't matter. I can still do a QCD.
Sure.
I can still take money out of my IRA and have it sent directly. And I can take up to $105,000 if I'm that charitably inclined from my IRA and send it as a QCD to the charity. And my spouse can do the exact same thing. So we can be very, very charitably inclined if we wanted to be. Because even it doesn't have to equal, it doesn't have to be the RMD. It's just that if I haven't taken anything out of my IRA, I can use it to satisfy the RMD.
Yeah.
Now, if I have taken money out, I can still do it up to $105,000 this year.
Yeah, it's not a bad deal at all. And
make sure that you tell your tax preparer that you did it. Don't just hand your tax preparer all your forms, your 1099s and things of that nature and say, tell me what I owe or don't owe or what my refund is. Tell them that you did a qualified charitable distribution, because otherwise they're not going to know it and you're going to end up paying taxes on that money. Because when it comes to the 1099, and the 1099 is the IRA custodian telling the IRS how much money left your IRA, the QCD doesn't have any kind of any codes or anything to it. If I have an IRA that sends $10,000 to a charity and it qualifies for a QCD, the 1099 is still just going to show a $10,000 IRA distribution, normal, everything just as normal as if I had taken it out to myself and spent it. So we have to tell the tax preparer or the tax preparing software that we gave it to charity so that it is accounted for correctly and is not part of the adjusted gross income.
Yeah, very important.
It's easy to do as long as the communication is there.
It is very important, and a good point to make, because your tax preparer is not likely going to do it. Now, if you do your taxes on TurboTax or one of those, any of those programs, I believe, and I haven't done it yet, because They ask. Okay, yeah, they should ask. So it should be okay there. But just if you have somebody fill it out, make sure that you do that. Now, one last thing on this, Professor Plum, is that people might say, well, look, you know what? I've given money to charity, but my standard deduction is higher than I'm covered by the standard deduction, so I don't get to write that off. But technically, this QCD is a kind of de facto write-off, is it not? By the very fact that you're not counting this required, if you do it for your RMD or anything else, that this income you supposedly would have taken from your IRA isn't counted. Would you put it that way?
Yes. I mean, what is a charitable contribution, even if I can deduct it? If I take money out of my IRA, it increases my income, and then I give it to charity, it decreases my income. So I get the increase first and then the decrease. If I do the qualified charitable distribution, it does not increase my income to begin with.
Yeah.
I don't get to decrease it later, but it didn't increase it to begin with. Yeah. So is it the chicken or the egg? Which one came first, the increase or the decrease? This one didn't happen at all. It was like it didn't even happen, and we like that.
Right. Yeah.
Because, as I mentioned earlier, the adjusted gross income, which does go up if you take money out of your IRA, is not. I mean, there's so many things that are affected by it. Your Medicare premiums, your net investment income tax, your Social Security taxation. There's all these different things that even though you may be able to deduct it later, it's already affected you.
Yeah.
So we try just not let you get infected to begin with.
We've said that, and some people might say, well, I'm really not that charitably inclined. I might give money to my church every week or something like that. But other than that, but you know what? You can do that. Take money out of your IRA and give that to the church every week. I mean, you can do that.
What do you give? $50 every week you go in, $100 every week you go in. That's $2,600 a year, $5,200 a year. Instead of giving it on a weekly basis, make one charitable donation in the year and be done for the year.
Sure. Yeah. Do it.
And if you want, and if you feel bad that people see you passing the hat and not putting anything in, have little pieces of paper made up that said, "I gave at the office." I did a QCD already.
I always wonder that people who, because you can
judging.
you give, okay, well, I was going to give $5,000 this year to the church. So I'm going to write it. I'm going to do a QCD and just direct from the IRA, and that's it. So I don't have to. When the collection plate comes by, I don't put anything in it. So if you have a couple of coins, drop them in. Plum suggested fake bills. I think that's going a little too far.
Fake bill. I don't want you to get caught by the Secret Service.
But it's a note. No, I don't mean a fake bill. I'm sorry. You just suggested a note saying I gave at the office, but it looks like you're handing something in.
Yeah.
Just to, it's all about optics. Well, that's good. So it's qualified charitable distribution. It's something people should look into, and you can do it here before the end of the year. Especially helpful, Professor, if you haven't taken your RMD yet, you should probably look into taking it fairly soon. Don't wait until the 30th of December.
But we're running out of the year to be able to do anything to affect our 2024 tax return.
Yeah. But this could be one of them. So
now, one thing that the Secure Act did for a business owner or somebody that runs a business, it used to be that if we wanted to put in a profit-sharing plan, a defined benefit plan, some kind of big retirement plan.
Oh, right.
We had to have the retirement plan in place, signed, and dated by December 31st. And then we could always fund it later if we wanted to. But we had to have it designed, structured, and put in place before the end of the year. We don't have that requirement anymore. We have up until we file our tax return with extensions to put the plan in place. Kind of like what we used to. One of the advantages of a SEP was it was kind of an afterthought. It was, we're doing our taxes in March, and we realized, we should have made a contribution.
You can go back.
Are we eligible for a SEP? Let's do a SEP.
Yeah.
That was the only type of retirement plan that we could do that with at that point, besides a traditional IRA for the individual. But on a business standpoint, the SEP was the only thing. Now, any plan can work that will, we can put in that big defined benefit plan, the cash balance plan, and potentially save a ton in taxes for this year, for this tax. I mean, I'm not kidding. A small business or a single employer that's making $200,000-$300,000 a year and realizes I want to save a lot of money, they can save with a cash balance plan or a defined benefit plan a ton of money. They may be able to, if they have the money available, write off all of their income for the year.
These are small business tricks. Maybe we should talk about that in another episode because we're about out of time here. But I like that. I like that idea. Now, you said SEP, SEP, Simplified Employee Pension. I should mention what that is. A lot of people don't know. But
it's a retirement plan funded by a business that allows the employer, there is no employee component to this, but obviously if you're self-employed, you are both the employer and the employee. The employer in this case is putting it in kind of. They put in, basically it's kind of a weird math between 20 and 25% of whatever your net profit is.
Yeah, it's 25 that winds up being 20, or is it 20 that winds up being 25?
Well, it's a little under 20 that ends up being 25.
Okay, I always get that mixed up, but anyway, we'll get into that in another show. If you need help with this stuff, talk to Professor Rick Plum, any of the advisors at Lucia Capital Group, 800-644-1150. That's the number at Lucia Capital Group, 800-644-1150, or go online. You can find a lot of this information at luciacap.com, LUCIACAP.com. You know that by now. Anything that you want to do toward the end of the year, as I said, it's getting a little bit late to do that, but this QCD, you can do it yourself. You don't really need the help of an advisor, but you can get somebody's advice, like Professor Plum, on what you should do and should you do it. Professor.
And to get to hit the new year running, we've only got a week or 2 or 3 left. To hit that new year running, calculate how much you're going to save in your 401k, divide it by the number of paychecks that you're going to do, and get that in so that your first paycheck starts off with getting yourself to that higher number. Don't wait till late in the year to change your contribution number. Start it off at the beginning of the year and spread it out over the whole year so you actually get to as high of a number as you can.
Yeah, that's good advice. Nothing but good advice on this particular program. That's the kind of advice you can get if you talk to Professor Plum or any of the Lucia Capital Group advisors. So do that. I would highly suggest that you do that. If you need more information on that, check our website at luciacap.com. Let's see. We've got, don't forget, I just mentioned very quickly, we got retirement guides you can download. I don't mention this enough, but a retirement guide, we got an estate planning guide, we have a buckets strategy guide, and a Social Security guide, which is going to have to be updated for 2025. That's a big chore, but you can still download it. The ideas are still the same, even if the numbers are slightly off. You go to luciacap.com. There's a search area up in the top. Type in bucket strategy, or you type in estate planning guide, or any of those, and it'll come up. Download it for free, read it, and if you have any questions on that, I'm sure we'd be happy to talk to you about that. It is important stuff. All of this stuff is important stuff that we talk about, and we hope we can make it simple for you and help you to understand that. So, luciacap.com. Subscribe to this podcast. That is a direct order from me to you. You can go to Apple Podcasts, Spotify, or anywhere else that you happen to be listening to podcasts. Subscribe and make sure that you listen to every single episode. Download them to your device, and don't miss one, because you miss a day, you miss a lot. Professor Plum, I thank you.
Yes, sir. You're welcome.
I kept you a little bit over time this time. I really hope I didn't chase off a bunch of people.
I just backed up my next appointment again.
Okay, good. That's right. Tell them you're in recording. Do they see the on-air light? My goodness. Ain't going to help more people out. That's probably a very good thing. I'll let you go. How's that? I appreciate you being here. For Professor Rick Plum, Certified Financial Planner Professional, I am your podcast host, Johnny Dean. Thanks for listening. It's Managing Your Financial Future. We will talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC.